In today's video, I'm going to share a quick clip from an interview that Bill Ackman, the founder of Pershing Square Capital Management, has to share on his views on interest rates, inflation, and where the terminal rate, meaning the peak of interest rates, is going to be, as well as his view on longer term inflation rates. So let's check it out.
Now the market is pricing in even more aggressive interest rate increases in the short term than the Federal Reserve has suggested. And I think the market maybe actually, it was, the expectations were too low before and they may be too high now. I'm not convinced the Federal Reserve is going to raise rates to 4.25% by the end of the year. I think they may go more slowly than that, but I think, the so-called terminal rate, likely will be something with a 4 in front of it, and we'll probably get there by sometime in Q1. And I think you'll start to see a moderation in the CPI numbers over the next several months, or certainly we hope that's the case. I think a more interesting question, and I would say more relevant to the value of companies, is long-term inflation and long-term interest rates. And that's where I think the Federal Reserve's view that, we're going to keep policy tight until we get back to 2%. I'm not sure we're getting back to 2%.
All right, so quite a few interesting things that he brought up. So his view is that he doesn't see the interest rates being raised by the central bank going up to 4.25 by the end of the year. He thinks that's quite aggressive. And his view is that we will be reaching the terminal interest rate, which will have a 4 in front of it. So it could be as low as 4% or as high as, say, 4.5 or 4.75. But we will reach that at some point next year. And that would be the terminal rate. That would be sort of the peak of interest rates. The market right now, so the interest rate market, is pricing in that the Fed has to increase it to 4.25 this year and potentially much higher. And if you watch in many investor circles, business circles, some people are calling for mortgage rates as high as 10%, and the sentiment has turned quite negative, which is normal, right? People, and as Bill mentioned, the market didn't expect rates to go up initially, so they were expecting rates to stay low or only increase very slowly, and that sentiment has now switched to the opposite end, where they're expecting rates to go higher and higher. He brings up something very interesting about the long-term inflation rate. So his view is that long-term inflation is probably going to be higher than 2%. It's likely not going to go back to a world of 2% inflation. This is a crucial piece of information for us, even as real estate investors, because if we know that inflation, for example, is going to be in the long term at 4%, we can then expect the central bank to have the central bank rate somewhere between 3 and 4%, right? If that is the going inflation rate. And therefore, as investors, our mortgage rates may consistently stay around 5-6%. So if we're looking at an investment deal to purchase right now, or say in the next 6 months, it may be worth looking at, okay, what is the yield this property is able to generate? What is its income relative to its purchase plus renovations? And if we can invest in properties that have a yield that's north of 6%, 7%, maybe even 8%, then in the long term, we know that if rates eventually they will peak, and the real estate market also eventually will bottom out, at which point, if inflation exists and continues, real estate can be expected to rise with inflation. Whatever that balance is in terms of where the inflation rate sits, then affects the interest rates that we will get on mortgages. So if you can find a deal right now that yields 7, 8, 9% in terms of the income that the property produces, a cap rate, so to speak, you're in a pretty good spot. Because if you can buy it right now where prices are low, and if the income is there to justify it, then you may have a high interest rate right now, and that interest rate may go down. It may not go down to the world we had before of 2% variable rate mortgages, but if you can create a an investment where you earn 8% on the value of that asset, and you pay 6% up to say 80% of the value of the asset, you're still in a positive cash flow territory, and the debt that you have is over time going to erode in value with inflation, and it is a manageable debt. The income of the property can pay for it over time. So hope you found that helpful.
Now the market is pricing in.
Hope you found that helpful. Again, this is one person's viewpoint. Obviously, any prediction when it comes to interest rates and inflation is just that. It is a prediction, so it has to be taken with a grain of salt. But Bill Ackman is someone I consider to be a thought leader in this area, and he has made some pretty good calls when it comes to inflation, interest rates, and in the last 2 years, he's made some very good calls. So I definitely will take this into account in my own investing, right? That, maybe we are approaching the terminal interest rate in the next short while, and maybe it's not going to be as bad as the market seems to think it will be right now. Hope you found that helpful. Until next time, all the best.